In this first of two videos, videos 19 and 20, which together address accrual and cash differences, we introduce the important distinction between revenues and expenses on the income statement, which lead to net income, and cash inflows and outflows in the operating section of the statement of cash flows, which lead to net cash from operating activities. The measurement of revenues and expenses is based on what we call the accrual concept, while cash inflows and outflows simply reflect the movement of cash. Both measures, net income and net cash from operating activities, are important indicators of a company's operating performance, but they tell us very different things. In the second video, video 20, we work a mechanical example. Let's begin with a simple balance sheet. The managers of Simple Company began the year with a balance sheet looking like this: a cash balance in the amount of $100, accounts receivable of $1,300. This account represents the value of goods and services that Simple Company has already provided to its customers and recorded as revenue. The company is still awaiting cash payment from the customers. Prepaid expense of $1,000. This asset represents operating expenses like insurance and rent that Simple Company has paid for but not yet used. They have paid for these expenses in advance and list the cost as an asset on the balance sheet. This leads to total assets of $2,400. Accrued payables amount to $800. This obligation represents expenses already recognized by Simple Company for which payment has not yet been made. Wages, interest, and taxes represent common examples. Accrued payables represent the opposite side of the transaction from accounts receivable. That is, each time a company has completed a service and recognized a receivable in revenue, the company on the other side of the transaction should be recognizing a payable and an expense. Unearned revenues of $900. This liability reflects the fact that Simple Company owes customers goods or services for which the customers have already paid. Unearned revenues represent the opposite side of the transaction from prepaid expenses. Again, each time a company pays cash in advance for an expense, the company on the other side of the transaction should be recognizing a cash receipt and a liability for a future obligation. To round out the balance sheet, Simple Company also has contributed capital of $500, direct contributions made to Simple Company by the shareholders in exchange for ownership interests. And finally, retained earnings of $200, a measure of Simple Company's past profits left in the company and not paid to the owners in the form of dividends. Overall, to start the year, the managers of Simple Company had at their disposal assets of $2,400, financed by liabilities of $1,700, and owners or shareholders' investments through either direct contributions or reinvested profits of $700. Assume the Simple Company started the year with this balance sheet, and during the year entered into a series of transactions leading to a statement of cash flows, which explains the change in the cash balance from the beginning to the end of the year, a statement of shareholders' equity, which explains the changes during the year in the shareholders' equity accounts, an income statement which matches expenses against revenues, highlighting net income, and finally a balance sheet, which reflects the company's financial condition at the end of the year. Let's now focus on two very important indicators of the company's performance during the year: net income and net cash from operating activities. And now let's explore why these two measures of operating performance have different values. As we get started, understand first that net income is the product of an accrual system of accounting that recognizes revenue when it is earned, not necessarily when the cash is received, and recognizes expenses when they are incurred, not necessarily when the cash is paid. Net cash from operating activities, on the other hand, reflects the actual cash inflows and outflows associated with the activities leading to the revenues and expenses that appear on the income statement. With this in mind, we now look at the balance sheet and focus on changes in certain balance sheet accounts from the beginning to the end of the year. These changes will help us better understand why net income is a different number than net cash from operating activities. Let's go back to the original balance sheet and take a close look at the four balance sheet accounts we reviewed earlier. Accounts receivable, prepaid expenses, accrued payables, and unearned revenues. All four have one very important thing in common. They all involve the recognition of a revenue or an expense at a time different from the receipt or payment of cash. That is, revenues do not match cash inflows and expenses do not match cash outflows. For example, accounts receivable arise when revenue from providing a service or delivering a good to a customer is recognized before cash is received from the customer. Unearned revenues, on the other hand, involve cases where cash is received from customers before a good or service is delivered and the related revenue is recognized. Similarly, prepaid expenses arise when cash is paid for services before the services are used and the related expense is recorded. And accrued payables are booked when expenses are recorded before cash payments for those expenses are made. All in all, these accounts and how they change from the beginning to the end of the period explain why differences exist between net income, which is equal to revenues minus expenses on the income statement, and net cash flow from operating activities, which is equal to operating cash inflows minus operating cash outflows, and appears on the statement of cash flows. In the next video, video 20, we record the entries leading to these differences and show mechanically how changes in these four balance sheet accounts explain the difference between net income and net cash from operating activities.